It's over. That's not clickbait. That's not fear-mongering. And it's not some exaggerated headline designed to get your attention. It's a statement of fact based on what just happened in the last 10 days. And if you're paying attention to what's actually going on instead of what the media is telling you to focus on, you already know something fundamental just broke. On January 11th, the Department of Justice served the Federal Reserve with grand jury subpoenas threatening criminal indictment of Jerome Powell, the chairman of the Federal Reserve. And today, January 21st, the Supreme Court is hearing arguments on whether the president can fire a sitting Federal Reserve governor. Let me say that again so it sinks in. The executive branch of the United States government is using the legal system to threaten the head of the central bank with prison and simultaneously trying to remove a board member who won't vote the way the administration wants. This isn't normal political pressure. This is the end of Federal Reserve independence as we've known it for the last 70 years. And the market knows it. Silver hit an all-time high of $95.87 on January 20th. Gold blew past $4,700 for the first time in history. The dollar is getting hammered, down nearly 10% over the last year and continuing to weaken. And this isn't happening because of some technical chart pattern, or because a bunch of retail investors decided to pile in. This is happening because the largest, most sophisticated investors in the world are watching the independence of the world's most important central bank get dismantled in real time. And they're moving capital into the only assets that don't depend on institutional credibility to hold value. Let me walk you through exactly what happened, because the details matter and the timeline matters. On January 11th, Jerome Powell released a statement that no Fed chair has ever had to make. He said the Department of Justice served the Federal Reserve with subpoenas on Friday, threatening a criminal indictment related to his testimony before Congress last June. Now officially, the investigation is about cost overruns on the Federal Reserve's headquarters renovation project. The project went from a budget of $1.9 billion to $2.5 billion, and Powell testified about that to the Senate Banking Committee. But Powell didn't mince words in his statement. He called it a pretext. He said the threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on their best assessment of what will serve the public, rather than following the preferences of the president. Think about what that means. The chairman of the Federal Reserve is publicly stating that the executive branch is using the threat of criminal prosecution to influence monetary policy. That's not speculation. That's not reading between the lines. That's the Fed chair saying it directly on the record. And he didn't stop there. Powell said this action should be seen in the broader context of the administration's threats and ongoing pressure, and that this is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead, monetary policy will be directed by political pressure or intimidation. Those are his words, not mine. The head of the central bank is telling you that the independence of the institution is under attack. Now, if that were the only thing happening, it would be bad enough. But it's not. At the exact same time, there's a case in front of the Supreme Court right now about whether the president can fire Federal Reserve Governor Lisa Cook. The oral arguments are happening today. January 21st, the president tried to fire Cook back in August by posting a letter on social media accusing her of mortgage fraud. Cook denied the allegations. A federal judge blocked the firing, and now it's in front of the Supreme Court. And here's the thing. The Federal Reserve Act of 1935 says that Fed governors can only be removed for cause, which historically has meant serious misconduct or inability to perform their duties. But if the Supreme Court rules that these allegations are enough to constitute cause, or if they say the president has broader removal power than previously thought, that's game over for Fed independence. Because once you establish that a president can remove a Fed governor for basically any reason they can come up with, every future Fed governor knows their job depends on keeping the White House happy, and that fundamentally changes how monetary policy gets set. Instead of making decisions based on economic data and long-term price stability, you're making decisions based on what keeps you employed. That's not independence. That's political control with extra steps. And the market is watching this play out in real time and drawing the obvious conclusion. Let me connect this to history, because this isn't the first time we've seen political pressure on the Federal Reserve, and we know exactly how it ends. In the early 1970s, President Richard Nixon put enormous pressure on Fed Chairman Arthur Burns to keep interest rates low heading into the 1972 election. Burns, who was a personal friend of Nixon's and a Republican appointee, went along with it. The Fed kept rates too low for too long even as inflation was starting to build, and by the mid-1970s, the United States was in the worst inflation crisis since World War II. Inflation hit double digits. Unemployment was rising at the same time. We got stagflation. That toxic combination of stagnant growth and rising prices that destroys middle-class wealth faster than almost anything else. It took Paul Volcker coming in as Fed chair in 1979 and jacking interest rates up to nearly 20% to break the back of that inflation. And it caused the worst recession since the Great Depression to do it. Millions of people lost their jobs. Businesses went bankrupt. Families lost their homes. And all of it could have been avoided if the Fed had maintained its independence in the early 1970s instead of bending to political pressure. That's the lesson. When central banks lose their independence and start setting policy based on what politicians want instead of what the economy needs, you get inflation, you get instability, and regular people pay the price. Now here's why this time is actually worse than the 1970s. Back then, the Fed's independence was a norm, a tradition, an expectation. But it wasn't firmly established in law or tested by the courts. Burns caved to Nixon's pressure, but he didn't have to worry about being indicted or fired if he didn't. Today, we're watching the legal framework that's supposed to protect Fed independence get tested in ways it's never been tested before. If the Supreme Court rules that the president has broad removal power over Fed governors, that's not just a norm being violated, that's a legal precedent being set. And once that precedent exists, every future president has that tool in their pocket. And it's not just happening here. Look around the world at countries where central bank independence has been eroded, and you'll see the same pattern over and over. Turkey is a perfect example. President Erdogan has spent years pressuring the Turkish central bank to keep interest rates low despite rising inflation, firing multiple central bank governors who didn't comply. The result? The Turkish lira has collapsed. It's lost more than 80% of its value against the dollar over the last decade. Inflation in Turkey hit 85% in 2022. Regular Turkish citizens have watched their savings get destroyed because their central bank couldn't stand up to political pressure and do what was necessary to control inflation. Argentina is another case study. For decades, Argentina's central bank has been under political control, printing money to fund government spending and keeping rates artificially low to juice short-term growth. The result? Chronic inflation, multiple currency crises, and a complete loss of faith in the peso. Argentinians don't trust their own currency anymore, which is why there's a massive black market for dollars and why the country has struggled with economic instability for generations. These aren't hypothetical scenarios or theoretical risks. These are real countries where the loss of central bank independence led directly to currency collapse and economic chaos. And that brings us to why silver is exploding. On January 20th, silver hit $95.87, an all-time high. Just to put that in perspective, on January 1st of last year, silver was trading at $28.92. We're talking about a move of more than 200% in just over a year, and it's not slowing down. Gold hit $4,700 that same day, also a record, and this isn't happening in a vacuum. The dollar index is down, treasury yields are volatile, and there's this massive flow of capital out of traditional dollar-denominated assets and into hard assets that don't rely on government promises or institutional credibility. The market is telling you something very clearly. When investors see the independence of the Federal Reserve being attacked, when they see the legal system being used to threaten the Fed chair, when they see the Supreme Court potentially opening the door to political control of monetary policy, they start to question the long-term value of the dollar. Because the dollar's value isn't backed by gold anymore. It's not backed by anything physical. It's backed by the credibility of the institutions that manage it. And if those institutions are compromised, if monetary policy becomes a political tool instead of an independent function, that credibility evaporates. Silver and gold are surging because they're the alternative. They're the assets you hold when you don't trust the people managing the currency. They can't be printed, they can't be created out of thin air, they can't be devalued by a central bank decision or a political pressure campaign. And right now, with everything that's happening, the smartest money in the world is saying very loudly that they want exposure to assets that exist outside the system, not inside it. Now let's talk about what this means for physical supply. Because this is where the rubber meets the road. You can look at a price chart and see silver at $95 and think that's just a number on a screen. But the physical market is a different story entirely. Major dealers are implementing minimum order requirements that didn't exist a few months ago. APMEX, one of the largest precious metals retailers in the United States, now has a $500 minimum order for silver. That's not because they want to make it harder for small buyers. That's because demand is so intense that they can't afford to process small orders and keep up with the volume. Premiums over spot price have been elevated for months. The spot price is what you see quoted, but the premium is what you actually pay to get physical metal in your hand. And those premiums are staying higher, going higher, which tells you that the paper price and the physical price are starting to disconnect. When you can buy a futures contract for silver at one price, but you have to pay significantly more to actually take delivery of that metal, that's a sign that the paper market and the physical market are not in agreement about what silver is really worth. And we're already seeing reports of supply tightness. Not full-blown shortages yet, but longer wait times, products going in and out of stock, dealers limiting how much you can buy in a single order. These are the early signs that physical supply is under stress. And here's the thing about physical markets. They don't give you warning before they gap. One day you can buy metal at a 10% premium, and the next day dealers are quoting you 30% or saying they're temporarily out of stock. Once the rush starts, availability disappears fast. China's export controls are making this worse. On January 1st, China implemented new licensing requirements for silver exports. Only 44 approved companies can now export silver from China, and they have to get government approval for each shipment. China is the world's largest silver producer, and they just turned the export tap into something they control. That's not happening by accident. China is treating silver as a strategic material, the same way they treat rare earth elements, and they're signaling that they're going to control the flow of that material based on their national interests, not based on what global markets want. What that means is that even if mine production stays steady, the amount of silver that actually makes it to Western markets could drop significantly. And when supply drops and demand is surging, prices go vertical. We saw a version of this in early January, when physical silver in Japan and the UAE was reportedly selling for around $130 an ounce when it could be found. That's an 80% premium over the spot price at the time. That's what happens when physical markets break away from paper markets. The price you pay to actually get metal in hand becomes disconnected from the price you see on the screen. Now I want to address something directly. Because I know there are people watching this who are thinking, okay, this sounds bad, but governments won't let it get that bad. They'll step in, they'll fix it, they'll do something. And I want you to understand why that thinking is dangerous. The whole reason we're in this situation is because governments are stepping in. The pressure on the Fed isn't coming from some external crisis, it's coming from the executive branch. The erosion of Fed independence isn't happening by accident, it's happening by design. Because the administration wants more control over interest rates and monetary policy. So when you say the government will fix it, what you're really saying is that the same people who are causing the problem will somehow also solve it. And history tells us that doesn't happen. What happens is that political pressure leads to bad monetary policy. Bad monetary policy leads to inflation and currency devaluation. And by the time the government tries to fix it, the damage is already done. You don't get to go back in time and undo the inflation. You don't get to restore the purchasing power that was destroyed. You deal with the consequences. And those consequences are real. This is why physical precious metals matter right now. Not as a speculation, not as a trade, but as insurance. You're not buying silver because you think it's going to make you rich overnight. You're buying it because you recognize that the system is under stress, that the institutions that are supposed to protect the value of the currency are being compromised, and that having assets outside that system is basic financial self-defense. It's the same reason you have fire insurance on your house, even though you don't expect your house to burn down. You have it because if it does happen, the cost of not having it is catastrophic. And let me be very clear about what I mean by physical. I'm talking about coins and bars from recognized mints that you either take delivery of yourself or that you store in allocated storage where you have direct ownership. I'm not talking about ETFs. I'm not talking about futures contracts. I'm not talking about mining stocks, although those might have a place in a diversified portfolio. I'm talking about actual metal that exists in the physical world and that you have control over. Because here's what happens when the paper market breaks. If you own shares in a silver ETF and there's a rush for physical redemptions that exceeds what the fund has available, the fund doesn't go out and buy more silver at market prices to cover you. They settle your claim in cash at whatever price they determine is fair, and that cash settlement might happen at the old paper price while physical metal is trading at a massive premium. You thought you had silver exposure, but what you really had was a cash-settled derivative that paid off at paper prices while the real metal was trading in a different universe. The same thing goes for futures contracts. If you're holding a futures contract and you try to stand for delivery, and the exchange decides that there's not enough physical metal to deliver against all the contracts outstanding, they can force cash settlement. And suddenly your silver position is just a pile of dollars, and those dollars buy you less than the physical metal would have been worth. This isn't conspiracy theory. This is in the contract terms. And it's happened before in other markets when physical supply got tight relative to paper claims. So when I say physical, I mean it literally. Metal you can hold, metal you can see, metal that exists independently of any institution's promise to deliver it to you. That's what matters when trust in institutions breaks down. And we're watching that trust break down in real time. The Federal Reserve Chair is being threatened with indictment. The Supreme Court is deciding whether Fed governors can be fired for political reasons. The market is pricing in a world where monetary policy is controlled by politics instead of data, and smart money is moving into assets that don't depend on that system staying intact. Let me give you a sense of the urgency without creating some fake deadline. I'm not going to tell you that you have 48 hours, or that prices are going to explode on Friday. I don't know exactly when the next move happens or how fast it happens. What I do know is that physical markets don't give you a gradual transition. They give you a gap. One day you can buy silver from a major dealer at a reasonable premium with decent selection, and the next day half their inventory is sold out and what's left is 10 or 20% more expensive. That's how physical markets work when they get hit with a demand surge, and we are already at the point where dealers are rationing supply. When a major dealer implements a $500 minimum order, that's rationing. When you go to a website, and products that used to be in stock are suddenly showing call for availability, that's tightness. When premiums that used to move between 5 and 10% over spot start consistently trading at 15 or 20%, that's stress. These are the canary in the coal mine signals. And they're here right now. The people who act while metal is still available get choice. They get to decide what products they want, what size they want, whether they want government mint coins or private mint rounds. The people who wait until the rush is obvious get whatever is left, if anything is left. And they pay whatever premium the market demands at that point, which could be double what it is today. That's not fear-mongering. That's how supply and demand works in physical markets. Now let's talk about what you actually do with this information. Because I don't want you to finish this video and just feel worried without having a plan. The first step is to assess what percentage of your wealth is sitting in dollar-denominated paper assets. For most people, that's the vast majority of their net worth. Savings accounts, checking accounts, stocks, bonds, retirement accounts, real estate with a mortgage, all of that is denominated in dollars, or depends on dollar stability. If the dollar loses 20 or 30% of its purchasing power over the next few years, all of those assets lose value in real terms. So the question is, do you have anything that moves in the opposite direction? Do you have assets that benefit when trust in the currency falls and when people start questioning the independence of the central bank? Physical precious metals are that hedge. They're the asset class that goes up when confidence in monetary institutions goes down. And right now, we're in the middle of the biggest confidence crisis in the Federal Reserve that we've seen in 50 years. You don't need to put your entire net worth into silver. That would be just as reckless as having zero exposure. But having 5, 10, 15% of your assets in physical metals is a reasonable insurance position. It's enough that if the dollar gets hammered and inflation comes back and the purchasing power of your savings gets eroded, you have something that's moving in the other direction to offset those losses. And if none of that happens, if somehow Fed independence gets restored and confidence comes back and everything stabilizes, you still have metal that holds value and that you can sell if you need to. It's insurance, not a gamble. The second thing you need to understand is that this is a long-term position, not a trade. When you buy physical precious metals, you're not trying to flip them next month for a quick profit. You're building a position that protects you over years and decades as the monetary system goes through whatever stresses are coming. Some of those stresses might be gradual, some might be sudden, but the trend is clear. More debt, more political pressure on central banks, more questions about the long-term value of fiat currencies. Those trends don't reverse overnight, and they don't get fixed by one election or one policy change. They're structural, and that means the need for hard asset insurance is structural too. And third, understand that the window for acting at current prices is not permanent. I can't tell you exactly when it closes, but I can tell you that every single time in history when there's been a rush into a physical precious metals, the people who waited wish they hadn't. In 1979 and 1980, silver went from $6 an ounce to $50 in less than 2 years. The people who bought at $6 did great. The people who waited until it hit 40 to make sure the move was real got crushed when it collapsed back down. In 2011, silver went from $18 to nearly $50 in 6 months. Same story. Early buyers won, late buyers lost. Right now, we're in the early stage of a move that's being driven by fundamentals that are stronger than anything we saw in 1980 or 2011. In 1980, silver was a monetary hedge, but it didn't have massive industrial demand. In 2011, the Fed's independence wasn't under legal attack. Today, you have both. You have the monetary crisis, and you have industrial demand from solar panels and electric vehicles that is growing every year. You have supply deficits that are projected to continue for years. You have China restricting exports. And you have the Federal Reserve's independence being dismantled in front of the entire world. That combination of factors is why silver is at $95 and why analysts are talking about $100, $150, even $200 as realistic targets. Not because of speculation, but because the structural fundamentals are that strong. And when fundamentals are that strong, pullbacks are buying opportunities, not exit signals. Silver could drop $10 or $15 tomorrow and it wouldn't change any of the underlying factors driving this move. It would just be noise in a much larger trend. So what's the actual next step? If you don't already own physical silver or gold, start building a position. You don't have to buy everything at once. You can dollar cost average, buying a little bit every month or every quarter, smoothing out your entry price over time. If you already have some metal, but it's a small percentage of your net worth, consider adding to that position while premiums are still reasonable and availability is still decent. And if you have significant exposure already, make sure it's stored properly, either in your direct possession or in allocated storage, where you have specific bars or coins assigned to you. Don't leave metal sitting in unallocated storage, where you're just one of many creditors with a claim on a pool of metal. Don't rely on ETFs or paper proxies, thinking that's the same as physical. And don't wait for the media to tell you it's time to act, because by the time CNBC is running specials about the silver shortage, the physical market will already be locked up, and you'll be paying double or triple what you pay today. I want to end with this. What we're watching right now is not normal. It's not business as usual. It's not just another political fight or another market cycle. We are watching the independence of the Federal Reserve, the institution that controls the value of the world's reserve currency, get attacked by the executive branch using the legal system as a weapon. That is a line that's never been crossed before. Not like this. Not this, openly. And the market is responding exactly the way you'd expect. It's moving capital out of assets that depend on institutional credibility and into assets that don't. Silver at $95 is not expensive. It's the market repricing the risk that the dollar is no longer managed by an independent central bank. Gold at $4,700 is not a bubble. It's the market saying that when political pressure overrides economic data in setting monetary policy, you get inflation and currency debasement. And those prices are going higher because the fundamentals driving them are getting stronger, not weaker. You don't buy insurance after the fire starts. You buy it when you smell smoke. And if you're smelling smoke right now, you're not wrong. You're watching the world question the independence of the institution that sets the price of money. That is smoke, and silver moving to $95 is the market's way of telling you it smells it too. The urgency is not that you have until Friday. The urgency is that physical markets don't wait for you to feel emotionally ready. When a rush hits physical supply, it doesn't trickle, it gaps. Availability disappears, then reappears at a much higher premium, or not at all. And the people who act early get choice. The people who act late get whatever is left. Make sure you're subscribed to this channel, because we're going to be tracking every development in this story as it unfolds. Every Fed statement, every Supreme Court ruling, every move in the precious metals market, we'll be covering it. Hit that subscribe button, turn on notifications, and make sure you're not missing updates. And leave a comment below, tell me what you think about what's happening with the Fed, whether you're already holding physical metal, and what your plan is going forward. This community is how we stay informed when the mainstream media isn't telling the full story. This is not the time to be passive. This is not the time to assume that everything will work itself out. The institutions that are supposed to protect the value of your money are under attack, and the market is telling you very clearly that it sees the risk. Listen to what the market is saying. Act while you still have the option to act on your terms, and protect yourself, because no one else is going to do it for you.